Welcome to another hEDGEpoint update. I'm Natalia Gandolphi from hEDGEpoint's Market Intelligence team, and I am here today with Paiva, our analyst for energy and macroeconomics.
Hi there, Natalia. Thank you for having me here.
As you've been following closely, headlines are transmitting concerns regarding the global economy, and they're not few, with China's GDP growth at 4.9%, down from the 7.9% in the previous quarter, having been affected by factors ranging from a property slump to issues in the energy sector. On the other side of the Pacific, we've seen US Federal Reserve policymakers cementing the prospects that Fed will begin tapering monthly bond purchases in November, with inflation and stagflation being the key words that are setting the tone for these conversations. With these issues serving as backdrop, what impacts could we expect in commodities markets?
Yeah, Natalia, I think that beginning with the Fed, it's important to look at history, short-term history, because in 2014, when the Fed ended its bond purchases, we saw this massive gain in the U.S. dollar index, being followed by speculators really trimming their net length in commodities. Right. So, and it's important to know that this was happening even though the S&Ds for some agricultural commodities like corn and soybeans were not um, were tight. So am I saying that in 2022, when the Fed ends the yet to start tapering process, is this likely to happen again? Looking back at history, yes, it can be positive, but ultimately we have to monitor the supply and demand balances for these commodities, right? And as you mentioned, I think that China is also sending some mixed signs to the commodity markets in general because there are a lot of domestic issues going on there, specifically the power outages that have been really impacting the activity within commodity importing sectors like the steel industry. And also, we've been hearing that some soy crushers have been asked actually to curb their operations amid all these power outages, right? So I think that China is also sending these bearish signs, but with these power outages. But we have also to comment about the fiscal policy that the Chinese government has implemented since the beginning of the year, which has been curbing the credit towards these commodity importer sectors like oil refineries, shipyards, and also iron industry. So all of these fundamentals have made the country's commodity demand fall and continue to fall in the short term. So the big question is whether they're going to be transitory or not. All right.
Right. Heitor, and these elements, these concerns over slow economic activity and higher inflation rates, they are affecting emerging markets as well, right? With monetary policy in terms of higher interest rates falling to play their part in supporting emerging currencies, correct?
Yeah, I think, Natalia, that even though some emerging markets have start their policy tightening, this has not prevented their currencies from devaluating and to stop inflation because, namely, inflation now is being driven by the supply side, and we know that monetary policies usually do not have that much of power under these circumstances. All right. But talking about the emerging some specific emerging markets like Brazil, there are also some domestic issues that have prevented the market from rewarding their monetary tightening. So we have domestic issues like the fiscal uncertainty and the approaching of the elections next year. So a lot of these fundamentals have been impacting and preventing these currencies from gaining. And overall, I think it's important to mention that China's demand for commodities has been falling lately, and this has impacted obviously the net exporters of commodities, which are namely pretty much every emerging market. So if China continues to demand progressively less commodities, then China is going to continue impacting their trade balances. And we know that a negative trade balance usually translates into a devaluated currency. So I think that the outlook for emerging currencies continue to be a short-term weakness over the dollar. And Natalia, I think that apart from the Fed and China, we have to start to talk about the supply chain issues that have been really impacting the global commodity markets. I know that you've been closely following this topic, so could you provide us some insights on what are your readings on this topic?
Well, the current supply chain issues are unprecedented in the sense that we've seen global trade recovering to pre pandemic levels in the span of 9 months, when in the past in the aftermath of the 2008 crisis, global trade took roughly 27 months to recover the same levels. And this time around, the imbalances triggered global congestion imports to skyrocket. And in this situation, cause and consequence feed on each other since supply chain issues trigger inflation. But there is a dilemma surrounding how much of inflation is caused by the supply chain issues and how much of it comes from demand itself. Still, as it stands today, the issue stems mostly from containers and container ships, with the order book for containers representing roughly 30% of the current fleet, when tankers and bulkers are averaging at 10%. And new capacity is expected to come in only in the next 2 to 3 years. So the issue for goods transported by containers that range from coffee to sneakers has been so extensive that chartering planes to move these goods has driven air cargo rates to soar to new highs, if you will. But moving inland, the situation sees no improvement, with small businesses in the United States increasingly reporting domestic supplier delays across several sectors, especially construction, wholesale trade, and retail trade. Truck freight costs have soared as the truck availability continues on a multiple year downward trend, and low availability increased during the pandemic. Another issue largely reported by businesses in the US is, of course, the shortage of workers, with the spread between job openings and jobless claims increasing to nearly 20-year highs, as openings increase even when claims decrease, suggesting that workers are not yet tempted to make the trade off between currently offered wages and the risk of getting COVID, while government benefits are still being rolled out. Now, moving from the short term outlook, what are the expectations for the next years in terms of global economic growth and some of the key elements being currently discussed that can hinder it, namely debt and inflation?
So I think that, Natalia, this is a very a tough question, right? Specifically now with COVID and these issues surrounding inflation and either in the commodity side, but also in the supply chains, because forecasting GDP is something normally difficult, and under those circumstances, it gets even more, even harder. So, but I think that there's a global trend in downwardly revisiting global growth in 2022, mainly driven by these factors that I just talked about, which is namely inflation, Chinese low GDP numbers. But one thing that called my attention is the fact that major banks are revisiting also China's growth going forward. So they're expecting China's growth pattern to start to soften going forward. So this can have like pretty much negative spillovers to the emerging economies which have actually a very significant market share in the Chinese commodity imports. So I think that if China continues to send these signs with slowing economy numbers, then the emerging currencies are likely to respond negatively to this and continue devaluating, right? Looking specifically at Brazil, we have domestic issues, but also this Chinese deceleration has been dragging the Brazilian real also towards undervalued zones.
All right. So, Heitor, let's keep tracking how China is going to develop and how the situation in the supply chains is also going to develop. We need to keep tracking those elements to understand how economic growth will continue in the next years. Thank you for participating, and see you in the next hEDGEpoint update.
Thank you, Natalia. Talk to you later.